At the end of the day, the prices of anything, whether stocks or real estate or gold, depends on supply and demand. When you have more sellers than buyers, if everybody's selling the McDonald's stock and nobody's buying it, the price is going to fall. But if everybody wants to buy the McDonald's stock, you have more demand than supply. Well, that's going to push the prices of the McDonald's stock up because now the buyers are going to fight against each other by bidding wars. And this is where you want to understand the factors that will impact supply and demand in the stock market. And the easier part to understand is supply, because this doesn't change as much. When a company lists the number of shares that they have, that's the amount of supply out there. It's a fixed number. If I divide up my company into 100 shares, that's the amount of supply that there is available to trade. But sometimes companies can change that. For example, Coca-Cola recently did a 10-for-1 stock split, meaning they increased the number of shares out there by tenfold. This doesn't mean that the value of their stock changed. It means the number of shares out there changed. So it kind of looks like this. If this was 1 share of the Coca-Cola stock, well, now you own the same thing, it's just divided up into smaller pieces. You now own 10 shares instead of 1. Each share might be worth $1 as opposed to 10, but you have 10 shares as opposed to 1. So it's the same thing, it's just the number of shares are different. So we're not going to talk too much about supply, but let's talk about demand, starting from a macro level. The first thing that impacts the demand of stocks is inflation. What is inflation? It's when there's more dollars out there. When there's more dollars out there, people have more dollars in their pocket. And one of the things that you can do with more dollars is take the money and use it to buy stocks. So if there's more money going into the stock market, that's more demand, which can push stock prices up, which is why inflation generally benefits stocks. The second thing that can influence demand is growth of a company. Because if a company reports that they're growing their profits, that they're growing their market share, that they're growing their innovation, that then becomes more attractive to investors. Because I might look at that and say, this company is becoming a lot better. They're making more money. They're growing a whole lot bigger. They're growing a whole lot faster. That growth makes it more interesting for me to want to go out and buy it. And that increased demand can then push that stock price up. But this is the part that I want you to pay attention to. Just because a company is making more money doesn't necessarily mean that its stock price is going to go up. Like we've seen many times where a company will grow their profits, but the stock price actually falls. That's why a stock's price isn't always directly correlated with their profitability. It's about supply and demand. It's about the investor's sentiment, the investor's emotion towards that stock. If a company's profit grows and investors get more excited about that growth, more investors buy, stocks go up. If a company sees smaller growth, they start to shrink, investors might be less interested, the stock price go down. But you can also see the opposite happen. If a company makes bigger profits, but investors are not excited about that company, they don't think that it's going to grow in the future, it might be making more money, but the stock price could fall. So at the end of the day, you have to understand supply and demand to understand where stock prices are moving, which brings us to number 5. How do you build a strategy for yourself as an investor? Now listen, I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The thing that you want to understand when it comes to investing your money is that personal finance is personal, and you got to know the right strategy for you. I break it down into 2 parts, into passive investing or active investing. Passive investing is what I call a set it and forget it strategy, where you set up a system where every week or every 2 weeks or every month, money is going to be pulled out of a checking account and invested. I'll show you where in just a moment, but it's going to be automatically invested and you don't have to worry about it. Active investing is for those of you that want to be a little bit more involved. You want to invest in individual companies. You want to do that research to understand where's the economy moving, which stocks could be growing in the future, what shifts are happening that you want to pay attention to. More work, more time, and you'd also be studying the financials, listening to earnings calls, and studying companies. This is not for everybody. This has more risk, but also more potential return. This has less risk, less time, less research, less potential return. You got to decide what's right for you. Again, I think most people should be passive investors, but for the some that want to be more involved, active investing can be a great strategy. I'm not talking about trading. I'm talking about just being more involved in which stocks that you actually invest in. This is one of the things that I teach in my investing masterclass. So as a passive investor, you're investing in funds. I'll explain what that means in just a minute. And this is a set it and forget it strategy. As an active investor, you're now going to invest in individual stocks. You're going to be investing in individual companies. This takes more work, more research, more time. but also more potential return. And with that, we've talked about the strategy. Let's talk about the different types of funds that you can invest in as a passive investor. There are three general types of funds that you can invest in as a passive investor. You can invest in index funds, ETFs, and mutual funds. They all work very similarly, that now you're investing in a basket of companies. Because now instead of investing in one company, like say Amazon, you're investing into a group of 500 companies or 1,000 companies or 2,000 companies, and you're not managing it yourself. The fund manager is doing the managing. All you have to do is just invest in the fund, and then they do all the work. But there are some slight nuances between index funds, ETFs, and mutual funds. That way you can pick the right type of investment for you. And let me break this down. There are three things you want to pay attention to: the fees, the number of trades you can make in a day, and the minimums that you need to actually go out and invest. With an index fund, the way that these work is that they're generally managed by a computer, an algorithm. And because of that, the fees are generally a lot lower because you're not paying for an expensive money manager. That means you can keep more money in the actual fund instead of making the money manager richer. When it comes to the number of times you can trade this a day, unlike a stock, which you can trade unlimited times a day, you can generally only buy and sell an index fund one time a day. And generally, yes, there are minimums in order to go out and invest into an index fund. I'll give you an example. VFIAX is the Vanguard Index Fund that gives the exposure to the S&P 500, meaning this is investing into the 500 largest companies in the stock market. Now, if we start with the fees, you'll see right here the expense ratio is listed at 0.04%. Again, this is an index fund, so you can only buy it or sell it once in a day. And you can see here the investment minimum is $3,000 to get started. We can compare that to a mutual fund, which are generally managed by an active money manager. So now, because you're paying for an actual person, your fees are generally a lot higher, but the goal is to get better returns. Unfortunately, we haven't always seen better returns in mutual funds. What we've seen is that generally over the long term, mutual funds don't always outperform index funds and ETFs after factoring in fees, but that doesn't mean it happens every single time. Then when we take a look at the number of trades that you can make in a day with a mutual fund, again, like an index fund, you can generally only trade in and out of a mutual fund once a day. And then when it comes to minimums, like an index fund, yes, there are generally minimums in order to invest into a mutual fund. Take a look. This is the T. Rowe Price Global Value Equity Mutual Fund. And if we start by taking a look at the expense ratio, this has an expense ratio of 1.09%. That's a whole lot higher than what we saw with the index fund, and in order to get started, you have to invest a minimum of $2,500. Then in the middle, we have this happy hybrid called ETFs, which stands for an exchange traded fund. And this one's interesting because when it comes to fees, they could be high or they could be low, because there are index fund type ETFs and mutual fund type ETFs, meaning there are passively managed ETFs and actively managed ETFs, so you just have to check. Then when it comes to how many times can you trade in and out of an ETF, it's unlimited, because you can buy and sell shares of ETFs like you can a stock right on your brokerage. And then when it comes to minimums, generally the answer is no. There's no minimum to get started when you invest in an ETF, minus whatever the cost of the ETF is, although many brokerages will allow you to invest in the ETF by buying a fractional share of it, so there's really no minimum that you need to get started with an ETF. Take a look. This is the S&P 500 ETF. This has a ticker symbol of SPY, SPY, and what you'll see is it has an expense ratio of 0.09%, so pretty low, and at the same time it says nothing about a minimum because there are no minimums for you to invest, and you can buy shares of SPY on really any brokerage. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.